Intro. I want to talk to you today like a friend who's seen the market cycles, the shiny high-yield ads, and the trade-offs behind chasing headline numbers. Over the last decade, I've watched investors pile into anything promising a big percentage, only to wake up to volatility, rising rates, or credit shocks. This video is about getting intentional with income, choosing funds that balance yield, risk, and the likelihood of keeping payouts year after year. We're not trying to maximize a single month's headline yield. We're trying to build an income stream that survives rate cycles, down markets, and changes in credit conditions. I'll walk through 8 funds: conservative options, actively managed multi-sector bond funds, equity income strategies, balanced approaches that I believe deserve a look for 2026 income planning. Vanguard Wellesley is the archetype of conservative income funds, roughly a 2/3 bond, 1/3 dividend-paying stock that's been around for decades. It isn't trying to chase the highest yield. It's aiming for steady, reliable income with lower volatility than a pure equity fund. For investors who prioritize capital preservation and dependable distributions, Wellesley is an obvious first stop. Historically, its yield is modest versus high-yield funds, but consistent. Think of it as the steady paycheck rather than the lottery ticket. Across rate cycles, bonds deliver income, while dividend stocks add cushion and occasional growth. That mix smooths returns and reduces drawdowns when markets get unpleasant. Most holdings are high-quality, investment-grade bonds and blue-chip dividend stocks, so rate sensitivity exists but is tempered by shorter duration and equity income. If rates spike, fixed income will move, but equities can blunt declines. In steady or falling rates, bonds support income. Best for income-first investors with lower volatility needs, retirees or conservative savers. Costs are low, turnover moderate, taxes straightforward. Consider munis in taxable accounts. Don't expect it to beat a roaring stock market or top yields today. Expect consistent distributions and better downside protection. The baseline to compare aggressive funds against. PIMCO Income embodies active, multi-sector bond strategies that hunt yield across corporate, mortgage, sovereign, and even emerging market debt. It's a yield-first, high-conviction bond shop that repositions across credit and duration. Yields tend to run higher than conservative balanced funds because PIMCO leans into higher yield credit and sometimes uses leverage or derivatives to enhance income. That boosts distributions, but adds spread and liquidity sensitivity, which can widen quickly in stress. Interest rate risk is managed actively, but remains meaningful. Skilled managers can outperform. Bad macro calls can underperform. Lower-rated corporates and structured credit elevate default and spread risk. In stress, leverage and illiquidity can deepen drawdowns or force selling. PIMCO's depth helps, but no one is immune. Understand derivatives, leverage caps, and liquidity before allocating. Use it as a satellite to raise yield alongside conservative anchors. Size and rebalance to your risk tolerance. T. Rowe Price, Equity Income, focuses on dividend-paying equities with a classic value, defensive tilt, large-cap, cash-generative companies that pay steady dividends. They seek sustainable payouts, not gimmicky yield. For equity-based income with some defense, PRFDX strikes a balance. Yield is typically higher than pure dividend growers, but lower than high-yield bond funds. You still ride equity ups and downs. Sector mix matters. Typically financials, consumer staples, healthcare, and at times energy. Managers prioritize durable cash flows and quality. Shareholder-friendly allocation, dividends, buybacks, and sensible payout ratios. Dividend growth can outpace inflation over time, but bonds defend better in drawdowns. If you tolerate equity drawdowns for higher long-term income, this can be a core equity income holding. Qualified dividends get favorable rates, but taxes still matter. Consider asset location. It's built for dividends and steady performance across cycles, not a growth masquerade. Expect income plus potential capital gains over the long run. Use it where you want income with upside potential. Vanguard Dividend Growth targets companies that raise dividends over time, not just high starting yields. That growth-first focus matters. Compounded raises can build a much larger income stream decades out. For long-term builders, this often beats chasing initial yield. Current yield is lower than high-yield funds, but dividend growth is the kicker. Over long holds, steady raisers can outpace inflation and lift distribution power. Exposure tilts to stable cash flow industries. Focus is financial health and room for increases. Qualified dividends help tax efficiency. Growing payouts can reduce forced sales. In taxable accounts, it can be efficient if cash covers spending needs. If you need max payout now, this isn't it. For funding needs years ahead, VDIGX is compelling. Think of it as planting a tree whose shade grows every year. Expect equity-like volatility in exchange for dividend growth and appreciation. Summary: lower starting yield, higher future potential. If your goal is to grow distribution capacity over time, add VDIGX to your shortlist. FSDIX blends equities and fixed income more flexibly than a static balanced fund, harvesting dividends and bond income opportunistically. That flexibility is the core selling point. Managers can rotate the stock-bond mix, shift sectors, and tilt toward dividend stocks or higher-grade bonds. Target yield sits mid-pack, higher than Wellesley, typically lower than high-yield or PIMCO. Capture diversified income without single-sector concentration. Useful as a core or complement in an income sleeve. Risks: timing and allocation execution. Tax efficiency can vary due to turnover and distribution mix. In taxable accounts, evaluate after-tax yield. In tax-advantaged, flexibility shines. For moderate, dependable income with upside to appreciation when equities run. A middle-of-the-road solution, neither ultra-conservative nor yield-chasing. Practical approach: use FSDIX as a dynamic core, complement with a conservative anchor, and add a higher-yield satellite. Capture flexibility without putting all your eggs in one risk bucket. BlackRock's multi-sector income fund targets higher current income by investing across corporates, securitized products, emerging markets, and at times convertibles. The goal: a diversified high-yield bond sleeve with scale and active management. A broad mandate allows moves into higher yield and less liquid sectors. Flexibility can enhance yield but raises spread and liquidity risk. Expect deeper drawdowns than simple IG bond funds in stress. Some use modest leverage or derivatives, magnifying income and downside. Always verify leverage levels, derivative usage, and liquidity management. Manager skill in credit selection matters most here. Expect higher distributions than conservative funds with greater sensitivity to credit cycles. Use as a satellite to boost portfolio yield, combined with stable anchors. Rebalance and monitor liquidity. It can pay well if you accept credit, liquidity, and leverage-related risks. Chapter 7. JPMorgan's income approach combines bonds, dividend equities, and alternative credit to build a diversified income stream. The idea: pull income from many sources so weakness in one can be offset by strength in another. That's attractive for steady payouts. Yield expectations run moderate to high, depending on posture. Managers adjust allocations as markets change. Diversification helps, but asset mix decisions still drive risk and return. Expect a blend: bonds for ballast, equities for dividends and growth, alternatives for additional yield. Designed for consistent distributions and a diversified role in an income sleeve. Use active diversified income thoughtfully. Size, rebalance, and stay aligned with your risk tolerance.